Okay, so let's see. So in our financial master program, I'm teaching investments too, so that's why I always like this topic. And actually, my career started by this way. So at the beginning, I was highly interested into different investments and investment funds. So as a master student, I was doing different investments into the investment fund sector, and that's why I was living through the small crisis of 2006 when first bad news were coming from the US real estate sector, and prices were falling down, so it was really interesting, especially that 2 years later the great financial crisis happened. So let's see that what can we learn about mutual funds and hedge funds in this case. So this is chapter 4. And the great problem is that it's quite hard to talk about the entire sector. Similarly, what I was doing about insurances, because yeah, it's absolutely a widespread topic. So we can, if you are focusing on mutual funds, then there are so many different approaches. Let's say, okay, so first of all, we have to define some of them. So mutual funds are focusing on small investors. So they are behaving like the commercial banks, that they are collecting small investors' money, just not into bank deposits, because they are providing different asset categories, and that's why they are way more riskier than bank deposits. But still, their importance is in capital accumulation. And also, they are providing diversification opportunities. Okay, we can say that yes, banks are doing the same thing, because if I'm giving a loan to someone, then I'm fully exposed to the partner risk. If I'm putting my money into the bank, then the bank will diversify the partner risk away if they are efficient enough. So still we can say that there are also common points, obviously, because investment banking is all this stuff together. So it's before the First World War, actually, banks were dealing with everything. So since then, now we have separate entities, but now since the 90s, everything was back together. So now still we have universal banks, but we can find the common grounds here. So it provides diversification opportunities. For hedge funds, it's much more, it's not a retail market, it's much more like a wholesale market. So they are focusing on big clients. And but the same thing is that they are investing money on behalf of individuals and companies, and they are doing pooled investors. So it means that it's not defined that whose money is invested into which asset. Everybody, all the investors' money will be invested, and then they are not defining that who owns what from the portfolio. And it doesn't matter that we are talking about a mutual fund or a hedge fund, still they have some kind of specified investment policy. And it's up to the fund managers, but after they defined it and they started to run their funds, then they have to follow it at some levels. And they can focus on relatively small investors. This is the territory for mutual funds. It can be focusing on wealthy individuals. Then it's much more like the territory of hedge funds. Obviously, in the case of mutual funds, they can go there as well. Or also large investors. Like I mentioned already, in the case of life insurances, then you have some additional investments on capital market and investment funds, then we can see that yes, mutual funds can appear here as a target. So for mutual funds, we can see that Diversification opportunities are really good, but so as an individual investor, if I would like to do this, I would like to have to buy so many different assets to have a diversified portfolio that it would ruin me because of the transactional cost. In this case, here mutual funds, they are doing it without high transaction costs. Okay, still they have to pay something, but they are having this benefit of economic of scale. So overall, their transaction cost levels are way lower, and also they can purchase in huge quantities. So yeah. Also, what is really important here that mutual funds on the liability side, they are issuing shares in the fund, and these shares are redeemable at any time, which are nice, but it's not that simple. So, because it depends on the exit strategy. So if we have an open-end fund, it means that we can join anytime and sell or exit anytime. So it means that the number of shares are going up or shrinking, and the amount of capital accumulated in the fund is also going up and down. And in many cases, you cannot do this in real time. So in Europe, it's limited, and also the book says that at 4 p.m. portfolio valuation happens, so the fund defines all the assets value and when the market closes, and then it defines the share value, and then on the next day, so if today I want to sell my share into mutual fund, then I put the order in at 4 p.m. or after 4 p.m. they are defining the value of the assets, and then on next day I will be paid because they are selling the assets, and payment will happen. This is the T+1 payment method, but in some cases there are T+2, T+3 funds, because it depends on the speed, how fast they can liquidate the assets and sell it back to you. Sometimes it happens that there are T+0 funds. Usually they are money market funds where the liquidity is so high in the asset that they can sell immediately and you don't have to care about. But this is not the usual case. Or that can be the closed-end funds. It's funny because closed-end funds are way older than the open-end funds, because in this case you need constant management. In the case of closed-end funds, they were developed during the 20s and 30s after the First World War. So it's quite funny because John Maynard Keynes was much more famous about his closed-end mutual funds than about his macro financial theories, what we nowadays remember. So he was organizing such funds, and in this case, when the fund is established, then the number of shares are defined, issued, investor money flows in, then you are not able to sell. At least you are not able to sell it back to the mutual fund until it expires. You are able to sell it on the stock exchange, someone else. So maybe, yes, we can say that, okay, but share value will follow asymptotically the value of the assets, but still we can say that if there is no deep liquidity, then if you are selling the asset or selling the share, then you can have lower revenues. So recovery ratio can be lower. So usually we can say that the market value is lower than the fair value. Someone would like to sell it before expiring. But for example, closed-end funds can be not just for mutual funds, but also for venture capital funds. So venture capital funds are also collecting capital for 10 years, and at the beginning investors must pay their investment, but after that they are not able to withdraw, only under extraordinary circumstances. So this makes the investments more careful, or and also the investment fund can take way higher risk than in the open-end case, because in the open-end case, when investors are seeing that, oh my god, it's going down, it's valuing less, then they sell immediately. So the mutual fund is punished against in case of volatility, and that's why it's punished in case of risk taking. In the closed-end fund, they can take higher risk because for at least the assumption of expectation of higher returns on the long run. So we can see here completely different motivations as well. So that's why this shares redeemable anytime. Yeah, maybe on the stock market or also in the case of open-end, the mutual fund. This net asset value definition is done on daily basis, as I mentioned already. They have a disclosed investment policy. So, for example, in Hungary, they have to announce a monthly portfolio report. But mostly this portfolio report, so it can be that for a share or equity investor company, that okay, they are just providing a pie diagram that 30% of our investment was invested into Hungarian shares, and 40% of the investment fund was invested into US shares, and still you cannot see that, okay, but which companies were purchased or which companies were invested into, or how long was this investment happen. So mostly what they are disclosing here, that they are focusing on equities, they are focusing on different assets, maybe on different markets, maybe in different currencies, or are they using options, are they using hedging strategies, but it still gives them a high degree of freedom. And also they have a limited leverage, so they can take up a loan, but usually this is not the case. Yeah, and what are the costs here? So the usual costs are that, first of all, when you have to purchase the shares on the market to do the investment, sometimes they are asking for commission, so this is called as front-end load. So I'm buying the shares from the mutual fund, and it has a transaction cost because obviously they have to invest this money sooner or later. And also there can be back-end loads. It means that if I'm selling the shares in the mutual fund, especially in the case of an open-end fund, then they have to sell the assets, so it also punishes them. So they are trying to demotivate investors to move back and forth frequently. At least this is how they can tax the investors. And also we can see that there is this total expense ratio, because still they have to pay for accounting services, they have to pay for using the stock market, the bond markets, maybe they have to pay for clearing house, they have a bank which runs their account. Also accounting was mentioned already. Usually they have to pay some fee for also to maintain their license. Obviously they have some people, so wages must be paid, and that's why it's interesting to see that which funds are more expensive and which funds are less. And or usually what we can see much more, that which funds are allowed to have higher expenses, because we can see that, okay, until the profit ratio is high enough, then who cares about expenditure or cost, shareholder cost. So we can see that really liquid funds like money market funds have way lower expense ratios than more sophisticated funds which are using, for example, options, or which are actively on the stock market. They have usually higher fees. So So yes. But cost ratios must be always checked, because yes, it's a nice thing to see that, okay, what was the historical return and what is the risk of this investment, but also entrance fees and exiting fees are necessary also to check before doing any kind of investment. Okay, but what is on the other end? Because I mentioned already that hedge funds can be specialized investors, and in this case they are not regulated so much as the mutual funds. So in this case, first of all, they are listed somewhere, so usually in tax havens, and still they are under the jurisdiction of the US Fed or the ECB or something like this. But yeah, so it's up to their lawyers how visible they are. But in this case, they can develop sophisticated, unconventional, proprietary investment strategies, which will work or maybe will not work. So I recommend you one excellent book which was written by a guy called Dunbar, and he was writing about the long-term capital management fund. And because this long-term capital management fund was created in the early 90s, and it was funded by people who were inventing the entire portfolio pricing, and they got the Nobel Prize for efficient market hypothesis and portfolio pricing. And at their peak time, they were responsible for half of the global options market, and they were introducing so many different derivatives which are still used on the market. Just the problem was that since they were using huge leverage, and since they were growing too big and they don't have sufficient capital, paid-in capital from the investors, after the East Asian crisis and during the Russian crisis in 1998, they nearly defaulted the entire market. So their total loss was $3 billion or something like this. So I will link this book because it can be really interesting, especially on master level. So risk can be hedged, because first hedge fund was created to have such options and risk hedge management, but usually they are way more aggressive than this one. So hedge fund can be, that's why misleading name, because this is not about hedging, just you have to name them something. It cannot be butterfly or something like this. And they are difficult to ignore because usually they are the most active investors on the market. So they have always some wise investment strategies which will maybe work or maybe will not work. And they are major players on convertible bond, CDS market, distressed debt, non-investment grade bond markets, ETF markets, and we need them because they provide liquidity. So both mutual funds and both hedge funds are necessary to well-functioning market. Hedge fund especially for risk management. The mutual funds are much more like for their liquidity, but both of them is necessary. Otherwise, if there would be only small investors or retail investors, pricing would be a way slower process, and it would be way harder to connect with and ask side of the pricing. Yeah. Okay, I talked about everything already, so let's go forward, because I want to talk about the portfolio of the mutual fund. So everything was moved up, and we can see that there are different active and passive approaches. So let's talk about active. It's funny because during the 80s, 90s and 2000s, active portfolio management was the holy grail on the market, and everybody was looking for the alpha. So how can you beat the market, how can you beat the market indicator index, and that's why at the end of the day they introduced this algorithmic trading and high frequency trading, and they created these different sophisticated derivatives and derivative strategies, and then it did not did so well until 2008. So in 2007 we were able to see that, for example, Merrill Lynch had enormous losses because their algorithm-driven fund started to burn I think 2 billion US dollars, or something like this was lost because of the misbehaving algorithm. So since then, passive investments are way more preferred among mutual funds. So it's funny that how it changes in time. But active investments are trying to outperform stock indexes. We can see that on average they can't do this. So there are different articles which are trying to assess active funds, and usually we can find some highly efficient investment funds, but the market on average, even in the case of mutual funds, now it is not good enough. Okay, so let's see the different strategies. So short-term money market funds. I like short-term money market funds because I'm always too lazy to invest into bank deposits. Because in the case of bank deposit, it should be a term deposit, otherwise it not pays you anything, or it will be ridiculous interest rate, and you have to wait for 1 month until you can get back your money, or still you can set it to 3 months or 1 year, but if you need the money earlier, then you are losing the interest payment, so it's way more difficult. In the case of money market fund, you are investing right now, then your money will be converted into a portfolio of nice interest-bearing instruments, or treasury bills, commercial papers, which is commercial bonds, just a short-term commercial bond. It can be bankers' acceptance, so at the end of the day they can make the bank deposit on their own, just not in the retail market but in the wholesale market, and that's why it can pay you higher interest, and it's much more flexible because you can buy it and sell it immediately at any time. You don't have to wait until some expiration date, and obviously there is no deposit insurance behind it. So that's why we can consider it as riskier, but it's quite hard to find stories when money market funds tend to default, so it has to be a really significant systemic crisis when it happens, because we can see that, yeah, losing money on treasury bills, commercial, okay, we can lose maybe money on commercial papers, or if the bank is going to default, so bankers' acceptance. It can happen, but it's not that common. However, we can lose some money if interest rates are increasing dramatically, because during this scenario bond prices are decreasing. So there is always a trade-off that if interests are increasing, then and also yields are increasing, then bond prices are decreasing, and in this case even money market funds can be hit, and there will be some small fall or decrease in prices, but still we can detect such events. But this is the sole case. How can you lose money? And also the biggest tragedy of the last now it's, oh my god, it's 14 years, so since 2008, that central banks were cutting down interest rates dramatically. So that's why in many countries in Eurozone or in the US interest rates were really close to zero, or sometimes they were negative, and mostly it killed money market funds. So I prefer to keep my euros, for example, in money market funds, but if they were closed down because we were not able to achieve any kind of return in these assets. So they were saying that, okay, please keep the cash. We don't care about your money anymore. In the case of the US, still you were able to get some 1% on US dollars. So it's still something, but they were hit hard. And it's really interesting because money market funds are operating also globally. So if we are looking on short-term lending of US dollars, we can see that European banks and Japanese banks, if they need US dollar on short run, so let's say for 1 week loan or in the form of 2 week loans, then they are going to US money market funds and they are taking up loans this way. So these bankers' acceptance can be cross-border. And then after 2 weeks they are renewing this position. And since 2008 this is not working efficiently. So in many cases the key central banks like the US Fed, European Central Bank, Bank of Japan, Bank of Canada, Bank of England, Swiss National Bank had to create swap agreements between each other because of the insufficient capital allocation in US dollar made by the US money market funds. So nowadays banks in the Eurozone or in Japan, if they need US dollar liquidity, partially they are going to US money market funds, but also they are going to their own central bank to have US dollar liquidity in form of swap agreement. So when we will learn about the swap market, I will talk about it in more details. Just in this case, you can understand way more details that this has. Yeah. Because I'm operating on high-speed internet and it's connected by wire, so yeah. Okay, so let's go to bond investment fund. So in this case, this is a fixed income security focus. It can be government bond, it can be corporate bond funds. So the maturity will be longer than 1 year, and that's why they are highly dependent of the structure of the shape of the yield curve, and they are highly the subject of the monetary policy. So if central banks are saying that okay, they are decreasing the interest rates on short run because there is a problem with deflation, then sooner or later they can start purchase long-term government bonds or even long-term corporate bonds to make the monetary transmission more efficient, and in this case it can cut back yields also in the long run, which is bad for bond investment funds. Right now, when inflation is growing, bond yields are increasing dramatically, and it can be also a problem because central bank can say that okay, since they have to fight with inflation, and they can liberalize or liberate the entire yield curve. So they can say that we don't want to manage this anymore, like it happened in 1979 October in the US, when the US Fed suddenly announced that they don't want to care about the yield curve anymore on long run. And what happens in this case, that yields are exploding in this case, and also bond prices are decreasing. So it can create huge losses in bond investments. And since nowadays in some countries some central banks are sitting more than 1/3 of overall government bonds, yeah, it can create issues if they stop their accumulation on the government bond market or corporate bond market, or if they start to sell some part of their assets. So bond market seems to be nice, but also we have to be careful because this is their policy specific risk. Okay, we can see equity funds. In this case, they can focus on common and preferred stocks. Usually they are using some kind of beta strategies, that they are looking for low beta assets and they can look for high beta assets, and if they are seeing that okay, market is more turbulent, then they are increasing the low beta assets in their portfolio, so that's why they can reduce the risk. And if they can see that the market is going up, then they are increasing the high beta shares in their portfolio. But usually much more healthier to combine bond and equity. So there are many hybrid funds which are keeping or combining bond and equity investments. And we can say that okay, we can diversify some risk away. So usually if equity markets are going down, then bond prices are increasing because there is an exchange in the money, so portfolio effects can happen. But the problem is that so let's talk about inflation, because right now this is an actual topic, and if inflation happens, obviously it's bad for bond funds. But for equities, we can say that until there is no recession with this inflationary period, so until we can see that okay, interest rates are going up, but also companies can grow healthily, so they can increase their ability to raise more cash, then this is not bad for equity markets. The bad thing will happen if inflation reaches some thresholds, and that's why interest rates are also reaching some thresholds, and above this level maybe loans are not paid back, so the amount of non-performing loans are increasing. Some companies are not able to pay their debt anymore, and we can see that share prices can go down. Or if we are evaluating companies with discounted cash flow methods, also if the weighted average cost of capital increases, then because of discounting, discounted cash flows, share prices can go down. So this increasing interest rate can create harm both for the bond market and for the equity market. So we can say that this diversification sometimes can fail. And also diversification is a nice thing just until we are assuming that correlation among different assets can be stable and constant in time. It sometimes happens, just usually it's not the case. So in equity market, in case of shock or a turbulent time, correlation is usually going up, especially inside different or inside the same industry. Also, this is the case for bond market. No. In the case of bond market, under turbulent time, usually correlation disappears. So they can have different effects. Also, for currencies, that's the same thing. So usually currencies around the Eurozone, they have high or quite strong correlation with each other. But if there is an external shock, then this correlation disappears temporarily. So that's why diversification can be misleading. Okay, and let's see passive investments. So in this case, investors are saying, or mutual fund managers are saying, that on average we cannot beat the market. So the alpha will be always zero, and all the fancy equity funds went into trouble during 2008, and also since there were so many crises. So in 2088 there was the first big crisis, that was the portfolio insurance crisis. After that there was the East Asian crisis and the Russian crisis in 1997, 1998. Then there was the dot-com crisis in 2001, and there was this great global financial crisis of 2007 and 8. So in all cases, people wanted and mutual funds tried to beat the market, and it was never ending well. So ETFs became highly popular on the market, at least from manager point of view. So let's compare them. So traditionally index funds were created at first because let's say that you want to track S&P 500, so Standard & Poor's 500 index, and you don't want to purchase all the 500 shares. So in this case, it's much easier to say that, okay, let's purchase a mutual fund. Let's invest into this, because in their portfolio they are buying everything, and it's much more efficient to do this way. But still they can choose to do so that they don't want to buy all the 500 shares, so they are saying that, okay, from each sector they are looking for the representative shares. So they are just running a regression that, okay, the share prices are changing in all 500 companies, then which companies are or have significant influence on the S&P 500 index, and they will just select it. In this case, you can also reduce the transaction cost. This is called Quadratic Optimization, and also they can use index futures. This is the low effort way because in the first two way at least they have some effort. But also you have a tracking error, so you have to see that the fund annual return and the index annual return, the difference, and also the volatility of this thing will be different. Just the problem is that it will always deviate away, because still we are talking about a mutual fund. So ETFs are much more sophisticated, and that's why they are much more popular, because a ETF means exchange traded fund, and in this case it means that we can buy and sell the shares of this mutual fund on the stock market. So and also they are mimicking an index, so they are like a tracking fund, but they are more sophisticated because the tracking error for them it's minimized, so it's really low. So they are highly fine-tuned, and they have to follow completely the index. And they don't have to keep liquid assets to pay out outgoing or leaving investors, because in this case they are just trading on the stock market. And it's funny because ETFs are growing, and sometimes they are too big. So in many companies nowadays we can see that ETFs became major investors. So they are above the 10% level, sometimes even they are reaching the 20% level, because if the same company is included into different indexes, and it can happen. For example, if you are big enough, then you can be included in Dow Jones Industrial, and you can be also included into S&P 500, maybe you are included into some sectoral index, like this type, the manufacturing industry or automotive industry. Maybe you are also included to some environmental index, and in this case all the ETFs in this which are following this index have to purchase your assets. So it's really good, because you can have some nice shareholders who have absolutely no interest in the company. They just want to track your prices and price changes, and to keep your company in the portfolio, so you can have really good silent investors. But also it can be a great problem that, okay, you have an annual shareholders meeting and 20% of your investors has absolutely no idea. But these major investors must delegate members into the board of the company, so they have some influence on the management, the efficiency of the management. They can have strategic influence. So yeah, it's a really strange situation. I will link in an article because yeah, it's also a big question nowadays that okay, we have ETFs and they are big ones, but they have this neutral influence on the management. So maybe I don't know what will happen later on in this market, but they became significant. And also they are highly popular among investors, and also they are really cheap to run because you don't need fancy algorithms to operate them. You don't need fancy brokers who will know everything better than the market. You just have to replicate a stupid index and that's all, and then collect commissions. so it's a cash cow. So usually ETFs, index and index traded funds and money market funds has the lowest costs, and bond funds, equity funds, hybrid funds have the highest. Okay, but let's talk about hedge funds because they are the most expensive investment fund from this graph. So first of all, their fees. So usually 1 to 3% of the profit will be accounted as a fee, and it depends on the performance and also operating cost audits, account administration, trader bonuses must be included there, and there is also an incentive fee. So overall 15% to 30% of the net profit can be also paid. So this is about the capital and this is about the profit. And at least according to the book, there is this usual 2 plus 20% fee. So 2% of the asset management and 20% of the net profit will be the revenue of the fund. And that's why they are motivating the mutual fund and the fund managers to pursue higher risk and obviously higher return opportunities, but there is always a lockup period, so they are focused to do it on at least medium run, not on short run within a year, but it has to be at least some, it has to have some kind of sustainability. So also, there can be other limitations. So there is this hurdle rate, which means that minimum return to reach for incentive to be active. So yeah, at least some kind of profit must be achieved before we are starting to pay premiums. Also, there is this high watermark clause. So it means that previously, if we had losses, then first of all we have to compensate them from the annual profit before we start to provide any kind of incentives. And there is this clawback clause, so investors can apply part of the previous incentives fees to cover current losses. So if in the past they were providing nice incentives, but now they are in losses, first of all it has to be covered by them, so there some part of the incentives will be kept on recovery account. So it smooths out its fee structure, but it makes way more reasonable, and also some unethical behavior can be limited by this way. So altogether, if we have to calculate manager incentives, we can see that first of all they have to be motivated to make profit and take risk, and that's why they have usually call option on the assets of the fund, and which will be based on the volatility of the fund due to the nature of option pricing. And yeah, so in this case, when we have to calculate the expected return for the investor, we can say that okay, this is the profit minus 2, then 1 minus 20% if it's on the profit, then we can do the following calculations, and then day we have the expected return here. And we can have prime brokers, and this it means that we have banks who provide services for the hedge fund. So these services can be related to high frequency trade, calculations of the collaterals. It can be related to borrowing securities for short being an asset. It can be cash management, it can be portfolio reporting, it can be loans to the hedge fund, it can be risk management, it can be ways to promote the hedge fund to the investor. It can be a stress test for the portfolio, so they can provide many different services. The problem is that in this case the hedge fund can be too transparent for the prime brokers, so big hedge funds are usually combining the services of different prime brokers, different banks, and in this case the banks cannot see what is happening inside the hedge fund. But in case of the hedge fund runs out of collateral, they can close down the position immediately. So they can say that, okay, we are not giving you any more loans, and then you have to sell your assets. This is what happened in the case of long-term capital management, because when the volatility was increasing by 1% in 1998, they were supposed to increase their deposits at the banks by 100 million US dollar, and sooner or later they were not able to do this because nobody wanted to lend them such money, so they went down. So that's why it can be dangerous. Okay, and then let's see different funding strategies. So first of all, we can have long and short equity strategy. So it can be a version of stock picking, which means that we are identifying undervalued and overvalued stocks, and then we are taking a long position in the undervalued and short in the overvalued shares. So if this one requires deep analysis, deep fundamental analysis, so some fancy discounted cash flow analysis or something like this, and the knowledge of this specific sector to identify these shares, and of course still we can think about what is happening when we have net long bias, so we have more long than short positions, or we can do the opposite, so less short bias when we have more short than long. It depends on that which market is expected, bull market or bear market. Also we can focus on small cap shares, because usually smaller companies have higher volatility, and also they can react much more on individual trades. So if we have a short contract in a smaller company, then the price will go down way more dramatically than in the case of a long or in the case of a big company. So that's why it can be also popular. It can have also some equity neutral position when long and short is the same. It can be dollar neutral, so it's equity neutral and the dollar amount of the short and long position is the same. It can be beta neutral when the average beta of the long and short position is 0. So I already mentioned beta strategy, that how they are related to the overall market or systemic risk, but this is coming back again. It can have sector neutrality, it can be factor neutrality, so how can we rule out oil price changes or interest rate changes and so on. Then let's go around this daisy, or sorry, dandelion, yeah. Here, because the next one is dedicated short. So let's look for the exclusively overpriced companies and let's short them. So this is sometimes what happens with, for example, Tesla. Several years ago, Musk was not that happy about shorting companies, and it's funny because you have to look for weak companies. So let's look for companies with weak financials, frequent auditor changes. Usually we have to change, or companies have to do regular auditor changes when auditors don't want to sign their annual report. So they are doing some shady stuff. So yeah, it's good, or they are delaying filing reports to the SEC. So you know that companies have to submit quarterly reports to the Exchange Commission or the other national commission which collects annual or quarterly reports, and if they are not doing this, then it can be also a nice way to short something, or if there is overcapacity in the industry, or if they are suing and silencing short sellers, so they are aggressive enough, then it's a nice incentive to step in and to short them and to serve market efficiency. Okay, and then let's focus on distressed securities. Again, so usually investors are focusing on high quality bonds. So AAA, AA, single A, maybe triple B, but usually that's all. So double B or lower is usually in the junk bond category. And these hedge funds are providing at least market for this one. So without hedge funds, companies or governments in this category would struggle way more to have or be financed. Because what can happen? So first of all, if bankruptcy happens, then there can be some reorganization. So all the former shareholders will lose their investment because share values will go down to zero, and then some part of these bonds will be converted to shares. And if it's efficient, then you can earn some money. If the reorganization is not efficient, then the asset liquidation can happen, and still, if the legal system is efficient enough, then you can have some recovery risk. For example, Templeton was following such strategy in 2009 and 2008 and 2009 in Hungary and in Romania, because both countries were hit hard by the global financial crisis. Practically fundamentals were the same, and governments were not doing anything, but suddenly sovereign bond market liquidity dried up, so they were not able to refinance themselves anymore at a reasonable price. So they turned towards the IMF for lending, and these government bond markets recovered really fast. So recovery happened within several months. But Templeton was wise enough to realize that this is completely a market mistake or market error. So they purchased government bonds at a really discounted price. And when markets recovered during the early 2010s, they were selling all this bond portfolio away, and they were closing it down until 2014 or 15, something like this. So in this case, they have to be careful, they have to evaluate well the position, but practically they were able to say that, okay, come on, if these countries are already supported by the IMF, they have to modify all their macro policies to meet IMF requirements, so it was not that risky. And they were able to see that, okay, what were the prices of these bonds before the crisis? If the crisis is over, there is a high probability that prices will go back to these levels, so why not to buy them? But in this case, you have to be careful, and also you have to understand the legal system and how these markets work. Yeah. Merger arbitrage. In this case, if merger and acquisition is announced, then they can focus that okay, there is company A and company B, and usually share prices are starting to become similar for company A and company B. So if company B is more expensive, then the share price can drop. Company A, if it's cheaper, then it will go up. So mostly they are purchasing both of them and taking up long and short positions, and they are waiting. And if the takeover will happen or the merger will happen, then they can be efficient. Because usually this actualization is not happening immediately. So the market still waits for it because sometimes it's not and so this discontinued merger can happen, so the market will be not efficient in this case. Or it can be share for share exchange. In this case it's way easier because you are taking a long position in the cheaper and short in the more expensive share, and still you are waiting for the market to do their job. Convertible arbitrage. So convertible bond, it means that converted to equity at a specified future time and share numbers. It's funny because you are way more careful than an equity investor, because it doesn't matter that the company is profitable or not, the convertible bond will pay you the interest. And also if the company is going to default or close to default, then still you have a higher chance that your convertible bond will be converted to equity, so you are not losing as much money. Or if they have to sell the assets of the company, then you will be paid earlier than obviously than the equity holders. So, and if the company is growing nicely, then they can reach some threshold levels when they can convert these bonds also to equity. So if you are keeping convertible bonds, sooner or later you will end up nicely. And it's funny because last time when I checked the Icon database and SpaceX investors in the Icon database, I was able to see that most of the investors, so unfortunately SpaceX is not traded on the stock market publicly. It would be so good, but no, they are not. And mostly or only they have venture capital investors, pension fund investors, or sometimes other private investments. But more than half of them are focusing only on convertible bonds. So it's funny to see that how can you collect equity. Yeah. Okay, fixed income arbitrage. So we have a zero coupon yield curve, and then we have the relative value in this case. We have this relative value strategy in this case. So let's purchase bonds which are undervalued by zero coupon yield curve, and let's sell the overvalued ones. Or we can have this market neutrals and no exposure to interest rates movements are defined, or we can have this discretionary strategy when we are using certain spread moves in the direction, or we can have some leverage and collateral. So I think that this is the most boring thing, but if someone is interested in the bond market, then they will enjoy this. But next time we will talk about way more about yield curve and zero coupons. So maybe next lecture or so within 2 weeks we will talk about them in more details. Emerging markets. I also already mentioned the Templeton story. So they are focusing on developing countries, and they have to understand what is happening on the equity market, because in this case undervalued and overvalued shares are not just depend on corporate performance. So in many cases we can see or identify macro risk and expectations about macro risk. So maybe the company is still a cash cow, but if expectations about macroeconomic performance or risk are changing, then it can drive the share price. Or also it can be a problem that, yeah, the share prices are increasing, but if at the same time the local currency decreases, then we don't have any profit. So that's why developing countries can be tricky. Also, there are these ADRs, American Depository Receipts, which means that the market is listed on the stock exchange, but not in the US, but through these depository receipts you can get some shares in it. Usually companies are doing it in China. Just recently this market was hit quite hard, so this is what I not recommend right now. And also we can see sovereign debt. Many countries are issuing not just in domestic currency their bonds, but also they are issuing bonds, sovereign bonds, in key currencies like US dollar, euro, Japanese yen, Chinese renminbi, Swiss franc. Okay, I don't recommend Swiss franc because that's the death trap. But usually other markets or other currencies I prefer because first of all they are cheaper, interest rates are lower, and also they can tap more liquid markets than at home. So they are not constrained only by the domestic savings, which is a great benefit. But obviously exchange rate risk, exchange rate exposure is highly there, and yeah, it can be tricky because, for example, in Hungary, 40% of the overall sovereign bond market was in the hand of domestic investors in 2008. And once foreign investments disappeared, or foreign investors disappeared after Lehman Brothers collapsed, and the entire bond market dried up, governments realized that maybe they should focus on domestic funding. So after that, Eurobonds were not that popular. Nowadays we can see some comeback, but many countries outside the Eurozone or around the Eurozone has mostly public debt in their domestic currency, and mostly they are focusing on domestic investors. So for example, in Hungary, we have nowadays this 60% instead of the previous 40. Yeah. Let's go forward. Global macro. So, like George Soros, focusing on trades that reflect global macro trends. Markets moved away from equilibrium, they will move back, so we can think that what would happen with foreign exchange rates, what would happen with interest rates, and the problem is that these equilibriums can happen for a long time. But if they are coming back, usually there is a crisis situation, so there will be some overreaction from the market. So yeah, it requires sophistication, it requires nerves, and it requires huge amount of capital to do so. Okay, and managed futures. So they are focusing on commodity price movements on future markets. Usually they are focusing sometimes on spreads. So spread between different maturities, let's say on crude oil market, or let's focus on spread between natural gas and crude oil market. So usually they are focusing on similar assets and pricing problems between